All right, so you're ready to think like Warren Buffett, huh?
That's what we're here for.
Well, today we're taking a deep dive into this book, Think, Act, and Invest, like Warren Buffett.
By Larry Swedroe.
Yeah, and I gotta say, the Swedroe guy, he really gets Buffett.
Oh, absolutely. He breaks down those complex financial strategies into something anyone can understand.
It's not just about picking stocks, though, right?
No, it's bigger than that. It's a whole philosophy.
Yeah.
A way of thinking about decisions, money, even life.
It's like a cheat sheet for success.
In a way, yeah.
So, Chapter 1, Swedroe lays out the foundation of Buffett's investment philosophy. And one thing that jumped out at me was how Buffett looks beyond the stock price.
Right. He's not chasing hype.
He wants to understand the real worth of a company.
He's obsessed with what he calls intrinsic value.
Intrinsic value. Now, that sounds kind of complicated.
Well, think of it like buying a house. You don't just look at the asking price, do you?
No, you got to check it out. Location, size, the condition, all that.
Exactly. That's intrinsic value. It's about looking deeper, seeing what that house is truly worth.
So Buffett's doing the same thing with companies.
He's scrutinizing their financial health, their earnings, their debt, how they manage their money. He's checking the foundation, making sure it's built to last.
So, like, if a company can consistently grow their earnings, even during tough times,
It shows resilience. That's a good sign.
he's not interested in those flimsy companies that could crumble with the slightest problem.
Nope. He wants the companies that are like oak trees. Strong, sturdy, weathered many storms.
And that brings us to Chapter 2, where things get really interesting, at least for me. Swedroe talks about discipline, which, let's be honest, can be tough when it comes to money.
Oh, tell me about it.
It's so easy to get emotional, make impulsive decisions.
Well, Swedroe makes it clear, emotions can lead to really bad financial choices.
Oh, yeah. Fear and greed. Classic recipe for disaster.
When fear takes over, people panic, sell their investments at the worst possible time.
And greed. Well, we all know what that leads to, right?
Chasing those can't-miss opportunities, risky bets, thinking you're going to get rich quick.
Been there, done that, not a good look.
Buffett avoids that trap. He doesn't try to time the market. He finds strong companies, invests for the long haul.
So instead of constantly checking stock prices, stressing over every little dip, it's better to just stay focused on the long game.
Exactly. It's a marathon, not a sprint.
Patience is key.
And Swedroe has some great advice on how to cultivate that patience, how to stay disciplined.
What really stood out to you?
Well, first, have a plan. Decide how much risk you're comfortable with, what are your goals, write it down, stick to it.
Like a roadmap.
Exactly. It keeps you on track when things get bumpy. And then don't put all your eggs in one basket. Diversify.
Spread the risk.
Invest in a variety of assets, different companies, different industries. Don't bet it all on one horse.
And of course, be patient. Don't chase quick profits.
The real magic happens over time. Compounding.
Compounding, the eighth wonder of the world. It's incredible how small gains can snowball into something massive over time.
It's truly remarkable. Swedroe illustrates it beautifully with real-world examples. Even small amounts invested consistently can grow exponentially.
It's like a superpower, right? Time is on your side. The earlier you start investing, the longer you stay invested, the more that compounding works its magic.
Exactly. That's why resisting those urges to jump in and out of the market is so crucial. You need to give your investments time to grow.
Okay, so we've got the foundation of Buffett's approach. Understanding intrinsic value and staying disciplined for the long game. Now, chapters 3 through 6, they get into some more specific strategies.
Right. How to build a diversified portfolio, what to look for in a company, all those practical details.
And in chapter 5, Swedroe dives even deeper into the value of patience and consistency, which, honestly, we can never hear enough about.
It's the heart of Buffett's approach. Finding those undervalued gems and holding on to them for the long haul.
Then chapter 6 takes those principles and applies them to your personal finances. Budgeting, saving, making smart money decisions.
It's all connected. But before we get into those chapters, let's switch gears for a moment. Chapter 7 moves beyond just the mechanics of investing.
Here's where things get exciting. It's like we're going from Finance 101 to Philosophy 401.
Exactly. It's about applying Buffett's wisdom to life in general.
So what were some of the big takeaways for you from that chapter?
Well, it was incredible to see how Buffett's principles extend far beyond just money. It's about living below your means, prioritizing what truly matters.
Finding contentment, purpose.
Exactly. Recognizing that true wealth isn't just about your bank account, it's about how you live your life.
In a world that's constantly telling us to buy more, achieve more, accumulate more, it's refreshing to hear that message. So what were some of those quotes that really stood out to you, the ones that really capture this idea?
One that comes to mind is, if you buy things you do not need, soon you will have to sell things you need.
Powerful, right? It's a wake-up call to be more mindful about our spending habits.
And then there's this one, investing in what others perceive to be risky and what is safe for you due to your knowledge, skill, and temperament is the road to superior returns.
That's all about knowing yourself, right? Understanding your strengths, your risk tolerance.
Absolutely. Don't just follow the crowd. Do what makes sense for you.
Okay, what else resonated with you?
This one's classic Buffett. Keep things simple. Do what you know to do, not what you think you know.
He's all about cutting through the noise, focusing on what really matters.
And then there's this gem, which I think challenges a lot of assumptions. Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble in investing.
Emotional intelligence.
Yeah.
That's what sets Buffett apart.
It's about mastering our emotions, not letting them master us.
Powerful stuff. Now, one more quote that really resonated with me was, why diversification is only required when investors do not understand what they are doing.
Ah, yes. Buffett believes if you truly understand a business, its intrinsic value, you don't need to spread yourself too thin.
It's about quality over quantity. Focus on those companies you really believe in.
Do your homework, build your conviction, and then be patient.
Okay, before we move on to some real-world examples of these principles in action, anything else from the book that jumped out at you, something we haven't touched on yet?
You know, what I found particularly striking was the undercurrent of optimism that runs through the entire book. Swedroe highlights that Buffett's not about doom and gloom. He's not trying to predict market crashes.
He's just saying, even in tough times, there are always opportunities.
For those who are patient, disciplined, and willing to do the work.
I love that. Okay, so we've laid the groundwork, explored the core principles that have made Warren Buffett one of the most successful investors of all time.
Now we get to see those principles in action.
In the next part of our deep dive, we're going to move from theory to practice, looking at real-world examples of how these ideas play out in the market.
Should be fascinating.
So stay tuned. Okay, so we've covered a lot of ground talking about the principles behind Warren Buffett's success. But now I want to see these ideas in action.
You want to see how it all plays out in the real world.
Exactly. Let's look at some of his actual investments, see how those principles translate into results.
Well, you can't talk about Buffett without talking about Coca-Cola, one of his most famous investments.
Coca-Cola, yeah, I remember reading about that. Didn't he start buying shares back in the 80s?
1988 to be exact. And it's still one of Berkshire Hathaway's biggest holdings.
Wow. So what did he see in Coca-Cola back then?
He saw a company with an incredibly strong brand, a truly global reach, and a product people love, let's be honest.
It's a classic, right? But from an investment perspective, what made it so appealing?
Well, think of what we call a moat in investing.
A moat, like around a castle.
Exactly. It's a protective barrier, a competitive advantage. In business, a moat makes it hard for rivals to challenge a company's dominance.
So, for Coca-Cola, their moat would be their brand recognition, global distribution, that loyal customer base they've built over decades.
Precisely. Those are all things that competitors can't easily replicate.
So it's a pretty safe bet that Coca-Cola is going to be around for a while.
That's the idea. And Buffett's patience with Coca-Cola has paid off big time. His investment has grown exponentially over the years.
That's the power of long-term thinking, right?
Yeah.
Betting on companies that can stand the test of time.
Absolutely. Another great example is Geico, the insurance giant.
Oh, Geico, yeah. Buffett loves insurance companies.
He does. He was drawn to Geico's low-cost model, their potential for growth. He first invested back in the 50s.
Wow, that's going way back.
Eventually, Berkshire Hathaway acquired the whole company.
So he saw the value early on, continued to increase his stake over time.
And again, it illustrates that power of compounding. Reinvesting those profits, letting those investments grow over decades.
It's like a snowball effect, right?
Right, yeah.
It just keeps getting bigger and bigger.
That's a great way to put it. And this philosophy, it's not just for Buffett. It's inspired countless other investors.
Really? So other people have taken these principles and made them work for themselves.
Absolutely. Take Seth Klarman, for example.
Seth Klarman, ring a bell.
He founded the Baupost Group, a very successful investment firm. He's a devoted student of Buffett's, focuses on finding undervalued assets, holding them for the long term.
So, same playbook, but his own success story.
Exactly. And his track record is remarkable. Outpost Group has consistently delivered great returns for their investors. They've navigated market ups and downs with incredible skill.
So it's not just theory, it actually works. That's encouraging.
It is. But it's not about blindly copying Buffett's every move. It's about understanding those underlying principles, adapting them to your own situation.
Don't just follow the herd, right?
Figure out your own risk tolerance, your own goals. Develop that discipline, that patience. That's the key.
So what does this all mean for our listeners? How can they put these ideas into practice?
Well, it means shifting your mindset, thinking long-term.
Playing the long game.
Exactly. It means making informed decisions, doing your research.
Not getting swayed by every little blip in the market.
And it means having the patience to let those investments grow.
Understanding that real wealth, real success, it takes time.
It's like planting a tree. You've got to nurture it, give it time to bear fruit.
Speaking of planting seeds, our next source has some great tips on how to cultivate that Buffett-like mindset, how to develop those habits and practices that lead to better decisions.
I'm ready for that. Let's dig into some actionable steps.
Okay, so we've explored the theory, seen how it works in the real world. Now let's get down to brass tacks. How do we actually think like Warren Buffett? How do we make it happen?
Well, it all starts with shifting your perspective, thinking long-term.
Long term, yeah, that's definitely not how most people think these days. Everything is so instant, so fast-paced.
Right. But Buffett's whole approach is about patience, holding those investments for years, even decades. That's how you unlock the real power of compounding.
It's like instead of trying to get rich quick, you're playing the long game.
Exactly. Instead of asking, how can I make a quick buck? Ask yourself, what choices will set me up for success years down the road?
I like that. It's about building a solid foundation, brick by brick.
And that foundation is built on knowledge. Buffett doesn't speculate. He doesn't chase hype. He researches, he analyzes, he understands those businesses inside and out.
So do your homework.
Exactly. The more you know, the better decisions you can make. And this applies to everything, not just investing. Choosing a career, buying a house, starting a business.
Don't just jump in blind.
Right. Now, another key aspect of Buffett's approach is managing risk. He's not afraid of risk, but he's calculated about it.
He doesn't gamble.
No, he understands that risk is part of the game, but he's always thinking about the downside, making sure he's comfortable with it.
It reminds me of that quote, investing in what others perceive to be risky and what is safe for you due to your knowledge, skill, and temperament is the road to superior returns.
That's a great one. It highlights that risk is relative. What's risky for one person might be perfectly acceptable for another, depending on their knowledge and experience.
It's about finding that balance, pushing yourself, but not taking unnecessary gambles.
Exactly. Now, beyond the numbers, beyond the analysis, there's another crucial element: emotional intelligence.
Oh, yeah. Buffett talks about that a lot.
He famously said, success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble in investing.
We need to master our emotions, not let them master us. Easier said than done sometimes.
Yeah, absolutely. But even adopting a few of these principles can make a huge difference in your life.
Well, this has been an incredible deep dive. I feel like I've learned so much.
Me too. It's always fascinating to explore the mind of Warren Buffett.
We've gone from the core of his investment philosophy to practical tips we can all use.
Hopefully our listeners are feeling inspired to start thinking, acting, and investing a little more like the Oracle of Omaha.
Now, before we wrap up, one final thought I want to leave our listeners with. We've talked a lot about investing in companies, but what about investing in ourselves?
Oh, that's a great point. Just like we invest in companies that we believe will grow and thrive, we can invest in our own growth and development.
Developing our skills, our knowledge, our talents.
Those are the investments that pay off the most in the long run.
It's all about making those daily choices that compound over time.
Laying those bricks one by one, building that strong foundation for a successful future.
Well said. Thank you so much for joining us on this deep dive into the world of Warren Buffett.
It was a pleasure to be here.
And to all our listeners, until next time, keep learning, keep growing, and keep diving deep.